Happy New Year and welcome to our first ever quarterly review. Looking back on 2018, there were many things that made for a pretty interesting year. Politics and personal things aside, the markets really gave us plenty to contemplate. My travels in 2018 led me to yet another year of gold status with United, but it also gave me the strength and perspective as I was frequently able to see the world from 30,000 feet, from 10,000 feet, and of course from 1,000 feet. And depending on the location, 30,000 feet is frequently far more breathtaking than 1,000 feet. I find it helpful to use those same perspectives in many areas of life, especially investing. By the time July arrived, we were looking at what seemed from 30,000 feet to be another potentially great year in the S&P 500. A closer look at 10,000 feet actually revealed that only 3 of the 11 sectors of the S&P 500 were actually doing well, even better than the S&P 500. And those were led by technology, somewhat reminiscent of the 2000s, the early 2000s. A 1,000-foot view really put things in perspective, whether we're observing from the window of a plane or through the rosy lens of the media's take on the S&P 500. What we found is that the S&P 500 was an entire index being led by 3 stocks, who were responsible for 71% of the S&P's return up and through July. That gave us good reason for further consideration. Should those stocks be owned in the portfolio, or are they potentially problematic because of valuations, momentum, or other reasons, basically fundamentals? Our conclusion was that with our great responsibility in managing your portfolio, we always will maintain a strong diversification among domestic and international equities, as well as fixed income. Moving on to the fourth quarter of 2018, October saw a 6.94% decline, while December brought a loss of 9.18% in the S&P 500. The previously mentioned 3 stocks experienced declines of 25%, 28%, and 11% for the quarter. And overall, we experienced the worst December in stock performance since 1931. Despite this market activity and the challenging environment across broad asset classes, there are points of optimism that would suggest that the outlook for 2019 remains somewhat possible. Fundamentals remain pretty strong, the economy is growing at a sustainable rate, and labor markets are as healthy as they have been in decades. In addition, inflation remains under control and corporate profits are still expected to exhibit growth in 2019. All these things and others should help stabilize the markets in 2019. That being said, there are also reasons to be cautious, including the largest layoffs ever in the construction industry in December. Note that there's 13 years of data on this. And mortgage applications at their lowest levels in 18 years. My belief is that we are much closer to the peak than to the trough of the current market cycle. We've been in a bull market since March of 2009, or roughly 117 months, which is the longest bull market in history. The average market cycle since 1937 has lasted 39 months, and market cycles are defined as peak to peak or trough to trough. Despite this, market indicators do not suggest such extreme market movements as the 2000 or 2002 dot-com bubble or the 2008 financial crisis. Domestic interest rates are not expected to climb substantially, and interest rates across the globe remain extremely low. Just because growth is slowing does not mean that growth is stopping. Earnings and economic growth are still expected to be realized in 2019, just not at the incredible pace that we experienced in 2018. A recession seems increasingly unlikely in 2019 given the current data, reflecting that the bear markets, like that experienced in late 2018, do not necessarily suggest a recession. Interestingly, the average recovery of a bear market that does not occur with a recession is 11 months, while the average with a recession is 34 months. As always, time will tell, and in the meantime, we remain diligent in our efforts to serve you well, and we welcome your feedback on our first quarterly market commentary video. Thank you, as always, for your trust and confidence, and for choosing us as your partner in reaching your financial goals.